Market goes up, open interest goes up. Market goes down, open interest goes down. Now, something changed, and Goldfix subscribers learned about it early. The mainstream media is still telling you they don't get it because that's their job. The market's moving because someone not in the US is buying it. Well, why is it going up if no one's buying it here? That's a good question. Because they're not buying it there. They're buying it over the counter. They're buying in Shanghai. They're buying it in London. They're buying it in private transactions. And every time they buy it in those private transactions, the guys who sell it to them, they buy what they can on the COMEX.
The sharp sell-off in gold prices, stemming from the failure to sustain near all-time highs of around $2,195, points to a significant market correction. As the precious metal dips to $2,160 and potentially heads toward the 20-day Exponential Moving Average, EMA, at $2,097, it reflects a mean reversion move after a period of wide divergence. Corrections of this nature are commonplace in financial markets, where assets often oscillate around their moving averages as they strive for equilibrium. In examining historical trends, Vince Lance observes that this correction in gold prices coincides with the observed divergence between price movements and open interest. While historical trends have typically shown a correlation between gold prices and changes in open interest, the post-October decline in open interest amidst market volatility signifies a departure from this traditional pattern. This shift in market dynamics indicates changing investor sentiment and behavior, with American and European investors displaying reduced interest in gold investments. Conversely, regions such as Shanghai and London experience heightened buying activity, often through private transactions. The simultaneous surge in buying activity in regions like Shanghai and London, coupled with the disinvestment by American and European investors, hints at a redistribution of gold ownership on a global scale. The influx of gold acquisitions in these regions, followed by purchases on exchanges like the COMEX, contributes to upward pressure on prices, indicating a stealthy accumulation of American precious metals by external entities. This phenomenon reflects changing market dynamics and raises questions about the broader implications for the global economy and financial markets. As ownership of precious metals becomes more dispersed across international borders, it may impact the traditional dynamics of supply and demand and influence the role of gold as a hedge against economic uncertainty and inflation. We will present clips from Vince Lance's interview with Arcadia Economics. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Gold or yellow line, that's the price action of the market. And the lower part of it is, just pay attention to the red line for this. The red line is the open interest. You can ignore the green lines for now. So what you see there is, you see on the top, you see the market. And on the bottom, you see the COMEX open interest, not the Globe's open interest. And it's pricing GLD on the right quadrant, on the right axis. But, this is gold, basically. Now, in the second one, we've identified a trend. And that trend is basically a correlation. And the red arrows show you that how gold normally acts. When gold goes up, open interest goes up. When gold goes down, open interest goes down. Now, why is that? Because gold is an investor market. Investors who put money into the market, or traders, let's call them traders. Let's call most of them what they are. Traders put money into the market goes up. Traders take money out of the market goes down. So direction is largely driven by investment/speculative price, which means it's relatively short-term based. These people are not taking delivery of the metal. These people are interested in making money day to day, week to week, maybe month to month at most. That's normal gold. Market goes up, open interest goes up. Market goes down, open interest goes down. Now, something changed, and Goldfix subscribers learned about it early. The mainstream media is still telling you they don't get it because that's their job. Something changed, and what changed started in, it started after October, but it wasn't in October itself. What changed was the market remained wide and violent, but still in a range for a time period up until, say, February 28th. And the open interest dove. So if The open interest has to go down when the market is going down and people are selling. That's why they're getting out. Why is the market not moving? Well, the market's not moving because the buying isn't United States based. The market's not moving because the buying isn't hot money based. The market's not moving because hedge funds are buying it. The market's not moving because, you know, uh, uh, your parents are buying it. The market's moving because someone not in the US is buying it. Well, why is it going up if no one's buying it here? That's a good question. Because they're not buying it there. They're buying it over the counter. They're buying in Shanghai. They're buying it in London. They're buying it in private transactions. And every time they buy it in those private transactions, the guys who sell it to them, they buy what they can on the COMEX, and the market goes up. For this time period of this green arrow, I believe, is the answer to why is gold going up. During this time frame, the marketplace was stable to higher, while American and European, I would assume, investors disinvested from the market, lost interest in it. So people were getting out of the pool. So what's going on? Well, somebody else is getting in the pool, and that somebody else is going to take delivery, and they've been taking delivery. And if you look at this, if you look at the COMEX inventories, I don't have that chart handy. You'll see what I'm talking about. Anyway, this is a stealth takeover of American precious metals. That's what this is. This is a takeover.
During the interview, Vince observed that on March 1st, there was a sudden surge in the gold market as new funds flowed in. This surge indicates the entry of many new participants, whom Vince calls tourists. These newcomers aren't motivated by deep analysis or solid financial principles. They want to make quick money. Their presence in the market adds excitement, but also brings instability. They tend to inflate prices artificially, pushing the market away from its true value. Vince sees that the influx of tourists makes the market feel like a lively but chaotic 4th of July pool party. However, just like vacationers who suddenly decide to leave, these tourists can exit the market unexpectedly, causing prices to plummet as speculative activity decreases. When these tourists start to leave, it signals a return to a more normal market environment. A decrease in open interest and price corrections suggests that the speculative frenzy they brought is fading. This sets the stage for a potential market rally, as genuine buyers find a more stable and sustainable environment without the tourists' influence. Let's get back to the interview.
Something changed again on March 1st, roughly, and the market started to ramp with funds buying. Now, what is that? That's the red arrow resuming itself. And the red arrow is everybody in the pool, right? But these are tourists, right? Red arrow people are tourists. They're not fundamentalists. They're not sound moneyists. They're just looking to make money because market go up. And so what do? They drive the market up because they're sloppy, they're irresponsible, they're not patient like the green arrow people are, and they distort the market higher. Everyone is in the pool, okay? It's 4th of July, high tourist season, all right? Now you've got a market that is very well bought, seemingly far away from where that fundamental green arrow buying is. And now you've got all these tourists going, well, we're here. What do we do now? Well, what do? After a while, they play around in the water a little bit and they get out of the pool because that's what they do. They get distracted. Oh, look, NVIDIA's moving. Let's take our money out of gold and put it in NVIDIA. And that's how it works. So people are getting out of the pool now. These are tourists. We want them to get out of the pool. They need to get out of the pool. How do we handle that? How do we take that? How do we look at that going forward? How do we use that as a tool to give us an idea, to give us some comfort when the market drops $50? Because it can drop $50 in a heartbeat. The market, if it drops again, if the yellow line drops to where I put that green arrow and the open interest drops to where I put that green arrow, then this market is in really, really good shape. Meaning, call this froth. Now, there's more froth than I'm saying, but call this froth. This is the tourist trade, okay? These are the tourists coming into your town, right? 4th of July, driving up the price of beer, emptying out the grocery store, and then they leave. And when they leave, when you're in this range again, in this area here, you're kind of in a normal environment. When these knuckleheads get out of the market because they're impatient, because they're distracted by something else, if this market is above this line, you're going to have a big rally, because that means that the tourists got out right down here and the prices remained elevated. And that means the buyer that was here before is now here.
Despite the short-term fluctuations in gold prices, there are many bullish indicators for the precious metal. Analysts, including Vince, anticipate a bullish trend for gold. The recent breakout to a new record high, confirmed by a weekly close above the prior high of $2,135, suggests a likelihood of reaching higher target zones. Bullish signals on the monthly chart further support this outlook, with the breakout stemming from a multi-year basing pattern. Fibonacci ratio analysis indicates the next higher target zone ranging from $2,235 to $2,247, with two 161.8% extended targets comprising this range. Beyond $2,447, the following higher target range is projected to be $2,277 to $2,298. Share your thoughts on Vince's prediction in the comments section below. If you like this video, please remember to give it a thumbs up, subscribe to the channel, and hit the bell icon so you never miss any uploads of ours. Thanks for watching.